We've got two different universes. We've got the active manager on the one hand, which try to identify the stock that will win over the long run. They can do a lot of fundamental research to justify why you should own that stocks against another. And that's what they do. And to do so, actually, they rely a lot on the sell-side analysts to provide them with research on the companies. And then they fine-tune the assumption from those analysts to their own beliefs to make their portfolio. What we do is very different, because we are saying we need a hedge in order to be smart and sophisticated in our investment. We want to rank the companies according to their innovation. To do so, we need a lot of insights on what's going on in the innovation side across a large set of technologies. And that's what we do with our portfolio, with our experts at the think tank. We try to identify those areas of innovation that are meaningful, that will drive the success of a set of companies that use those innovations. The traditional approach now is moved to passive, because passive provides the global exposure to the market, and you don't have to worry about this bias or survivor bias, as we call it, that the active manager have. The problem when you invest passively is that in the end, you're also exposed to those losers over the long run. You're more exposed than with a smart or sophisticated approach like we have. We try to identify what are the factors that drives the winners. And that's, for us, is innovation. And that makes a big difference between passive investment and us. And that also makes a big difference between active investment and us, because we are not trying to identify the stocks that's going to win over the long run.
We are in the business of trying to select for companies that can, through the cycle, not only survive but progress, and that through the products and services that they sell, create superior earnings versus other companies in their industry. But we don't do that with the traditional approach of rigorously analyzing company balance sheets and income statements and meeting management teams. We are in the business of identifying innovation. And the happiest investors that we know currently are the ones that moved in early, that have been with us for the longest time. They're still positive, are the ones that are looking for quality companies, for companies that are able to not only survive through different market environments, but also through new regimes and through new product cycles and new things that are happening in the world. And those are, in our terminology, singularity companies or innovation companies. But the investors that have an approach to investing that isn't moving all your money in and out at a certain time, or that don't subscribe to a timing methodology, but the ones that have actually consistently added to our portfolio. And and averaging in on your buying price has been basically the best approach to investing by and large, but definitely also for our strategy. The unhappiest investors that I think we are going to have are the ones that expect us to time market sentiment and to time factors, because that is not the business we are in. Interestingly, the expert insight that we create and that feeds our innovation scoring model has foreseen changes in market regimes, if you will. Some things that we changed in our portfolio already last year did play well for this next cycle that we are moving into. And some technologies and innovations have been, through our expert think tank, considered peaking. And with that, we've moved out of those innovations or out of those commoditized areas of innovation and moved into new ones. So it's interesting to see that an innovation approach also leads you into those areas of the market, despite us never playing with being a macro investor or a factor investor at all. It's a tricky subject because it's a...
Midsommar.
Okay.